Welcome again. My name is Peter Chega. Today, let's see the types of stocks you find at NSE. Again, this is a beginner series. In the previous tutorial, we saw what shares are and how shares work. So today, let's see the types of stocks you see in the market. So there are two types of stocks at NSE, Nairobi Securities Exchange. One of them is dividend stocks. Dividend stocks are companies that share their profit with you in cash, usually every year or twice a year. So what they are, these are companies that make steady profit and they choose to pay part of that profit to shareholders. That's what is called dividend. So how does it work? A company makes profit in a year. When they are doing either their half year, it could be Q1, Q2, Q3, that is Q1, Q2, Q3. Or when they are announcing the final audited results, they have made profit. They decide part of that profit, then share it with their shareholders. It has to go through the board approval, then it will be announced. Then if you have shares on book closure, you qualify for that dividend. So dividend stocks now are the companies that give dividends, that pay out dividend frequently. And that dividend, I've said, it comes from the profit they make. The extra profit they make, they share that with their shareholders. So how then does it work? You as the shareholder, you buy shares in that company. Let's say Safaricom, you buy shares, they have not closed their books. On book closure, the total that you have, that's what qualifies for dividend. Like let's take an example of ILM. So you buy shares. The company has been in operation, it is operating, it makes profit. When they audit their books, when finance team, they do the quarter results, maybe Q3, or half year results, or final year results, audited results. For final year is usually audited. So they realize they have made good profits. They decide part of this, let's declare it as dividend. We pay back something to our shareholder. So that goes to the board, it is approved. Once it is approved, now you receive money directly to your bank account or mobile money that is linked to your CDSE account. So when you're opening an account in CDSE, there's a bank account you give. We'll see that when doing the account opening. That bank account is where your dividend is paid to. Whereas and when company declares, and for you to qualify, you'll see when we are doing dividend, there is a book closure. If you have shares at that date, the total of shares you have that day is what qualifies for dividend. So it will be paid directly to you. So it is you to decide what to do with it. It has come to your bank of M-Pesa. You can decide to spread it, or you do what this channel has been training, reinvest it into more shares that are giving you dividend. So you have received free money, you go back, buy shares that give you additional free money. And you continue like that, then you find that after some year, you have built a very strong portfolio using dividend recycling or dividend investment. Recycling is where you reinvest in the same company. The investment is where now you move that dividend to another stock. We'll see all that when we come to the next slides, the next training. So why people like dividend stocks? One of them is you are guaranteed your income. When profits are strong, you always get that dividend. They are less risky. You find these are not companies which can collapse anytime. They are stable and well established. They cannot be suspended. Their price is always stable. Even if it goes down, those companies will still rebound back. Long-term investors, they usually use these dividends maybe to pay bills, also grow passive income. Remember, you're receiving free money. Reinvest into more stocks, and that compounds your wealth over time. So the key point here for dividend stocks, it's stocks that give you free money without selling shares. Remember, you're not selling your shares. Shares remain in your CDSE account. Price may grow in future, and you can sell. But dividends will still be coming as free money. The second type of stock is growth stock. Growth stocks are companies whose share price increases over time, giving you profit when you sell. I want to clarify this because there is confusion in the market of what growth stocks are. Again, I repeat, it's companies which have potential in growing in price, not in price in terms of their performance, but price at NSE. So this price increases over time and you're able to sell at profit. Remember, you're committing money. This money you're not giving that company. The company got money when they listed during IPO or when the shares were floated the first time, maybe through private placement. So they no longer need money from investors to expand. They have done that. So these are companies which are already listed at NSE, and you as the investor, you have seen there is value in buying shares in this company. This company have future growth. And that future growth may project that price may go up. When price goes up, remember the value of your portfolio valuation goes up. You can sell at a profit. So growth stocks, you can only realize your profit by the actual sale. So what are they? People always think growth stocks means company that's growing fast. It has nothing to do with company growing fast. In reality, so theory is company that is growing fast. That's what we have been taught in college. When you come to an NSE as a trader, like now we whom we trade either online or those who trade through brokers. Growth stocks are any share that you buy that increases in price with time. And these companies have strong fundamentals. Why am I saying this? There are companies which are growing in price but don't have fundamentals. Look at Uchumi. It has been hyped. And those people who are hyping, they actually bought it at lower price. They even telling you, you bought it at lower price. Then when price is appreciated, they sold to you. They kept on giving you hopes. Now, I think as of today, you've seen supply have now blocked demand. Prices have started to fall down. And unfortunately, that is the reality. I'll come to that at the end of this so that you know companies which are appreciating in price are not always growth stocks. Company have to be supported by strong fundamentals. Uchumi have no fundamentals. Profit from just rentals, that's not something you can even talk in the industry. In NSE, that one, I don't think it stands in a test. That China Square, the tenant can decide to close down and move, or something happens, they close them. Apparently, they also have, Uchumi have expenses to pay. Where are they paying from? This, I'll come to that. Let's first walk this through out. So growth is about your investment, the money that you have put in growing, increasing in value in terms of portfolio valuation, not just company growing. Company growing, it doesn't help you as the investor. It only helps you if that growth is projected in prices. So a company can be growing, but share price goes nowhere. There are so many companies at NSE which they keep on innovating, but price never moves. Company can be slow, but the share price can jump because of positive demand, positive market trends, and positive investor in sentiment. Like Safaricom, it is always appreciated in price. Were it not for government interference, that price right now would be way above 50. But they have to justify the sale price of Safaricom share, the government shareholding. I've done that full video. Look at banks, Equity Bank, NCBA, KCB. Their price always goes up. They rally up. Those are growth stocks. But remember, they also give dividend. So a growth stocks can also give dividend. The only difference is a pure growth stocks is where your price, the price of share keeps on increasing over time. And there is a future of that price even going further up, growing your portfolio valuation. So why growth stocks increase in price? A share price, mostly in NSE, not any other, forget about the theory. In practice, in NSE, the share price will only rise because of several things. And the major one is more people want to buy the share than those selling it. So you find demand is higher than supply. In NSE, that is the main reason why prices move up. Demand exceeds supply. It's the same thing if there are people buying like loaf of bread and there are few supplying, the price will go up because of demand. It's the same thing. If there are more many people wanting to buy the share than the ones who are selling, automatically that price will go up. And the main reasons, good profit. A company that is making good profit, everybody wants to be associated. Expansion plans, market hype, but positive market hype, not negative. And positive here, I mean, it's something that can be seen and it is tangible. You are saying Equity Bank, it's performing well in the market, and that can be seen on their results, even historically. Not companies like Uchumi, which has been suspended before. Scarcity of shares, that is, there are no more people willing to sell. That will push prices up. Positive news, that hypes the market. Social media hype, that will push prices up. Strong demand from institutions and foreign investors, they always push prices up. But remember, for growth stocks, that company have to be supported by fundamentals. So how growth stocks makes you money? You buy low, hold on to those shares. Even if you buy some at higher price, you hold on to them. Then when prices go down, you buy more, actually in more numbers. You do something called dollar cost averaging, where you push your average cost. But remember, there are those we have bought at a high price. So that averaging pushes your average cost down. Then you wait for prices to rise in the future. You sell at high profit. That profit is what we call capital gains. So buy low, hold on to those shares, prices go up, you sell high, you get your profits. That's what is called capital gains. The reality of growth stocks, it's not about the company doubling in size, new offices, new market management speeches. Those have no effect on your portfolio valuation. Growth here, we are talking you as the investor growing, not the company. I said company got money during IPO and private placement. It no longer needs money from investors. If it needs, it will come in either as a rights issue or they float a corporate board. So the money that you are buying actually somebody who are invested in that company. You are buying them out. You are giving them money, they get out, you get the shares. If those shares don't appreciate in price, then it's not helping you. So in reality, the growth it's about how share price behaves, whether your investment appreciates, portfolio valuation, what is your profit? That's what we scored growth. Don't measure it with companies. Just go to your portfolio valuation, you see it there. Dividend, you're actually receiving money. So you have a way of measuring growth stocks by just checking your portfolio valuation. How is it performing? How is the future of that company? If that company have a future in appreciating the price, it means the current value, the future value of your stock will be higher than the cost, meaning profit. So how are growth stocks created? One, through IPO. So company will list through IPO or through introduction, listing by introduction. That is the time you buy shares. Through IPO, you apply, you are rotated. Listing by introduction, they are just floated, existing shareholders, they sell to you. From there, three things must happen, and three things must happen. Either price appreciates, you gain. If price goes up, you're in profit. Or price stabilizes, maintains your price, your value doesn't change. Your money holds value. But remember, when you sell, costs will eat into your value, meaning lower cashback, which could lead to losses, or price may drop, you lose. And losing and gaining only happens when you do the actual sale. As long as you're not selling, you're not losing. Prices keeps on fluctuating. They will go down, your portfolio is in red. They go up, it is in green until you sell. You can't realize the profit or loss. If you want to get your gains, you do the actual sale. If you sell when it is the prices have gone down below your average cost, you lose. That's the only time you lose, when you do the actual sale. So some of these companies, they don't pay dividends, but still reward you through price appreciation. Price goes up, you make profit, you sell. Bonus shares, they make profits. They don't share it in form of cash dividend. They earn you more shares. Remember, these are free shares. When you sell, capital gains. Or share splits. Company price goes up. They decide, instead of us holding at a high price, let's do a share split. We divide the price by 3 or 5, then multiply share number by 5. Remember, you have been added more shares, but the value doesn't change because the price have gone down with the same ratio. When price increase in future, remember there is the additional shares you got when you sell the in profit. Equity Bank, that's why I said it's a growth stock. They have done splits before. And those people who have never sold, right now, they're in profit. They just sell at profit because the additional shares they got after split, they have appreciated in value. What growth stocks are not? Remember I said most people confuse this word, growth stock. Growth stocks are not cheap stocks. They are not penny stocks. I've said they are shares that help your portfolio grow in valuation and not penny stocks. Why? We have cheap stocks at NSE, which are very below 10 shillings, but they still give dividend. Those are cheap stocks. Kenyari, CIC. There are others which still fluctuate within, but they are penny stocks. Penny stocks are stocks below 5 Kenya shilling, 10 Kenya shillings, and they are just very cheap shares, which one, the company is struggling, two, has weak financials, market has little confidence in it, there is low demand, and it has limited or no dividend. But remember, Kenyari, CIC have dividend. The rest, I don't think there is any other which gives dividend below 10. I think Kenyan have shifted back to penny stocks. Price have gone down. And poor governance and past losses. So cheap doesn't mean it will grow. Look at Uchumi. Yes, prices are going up, but is the company growing? No. They still have, I think, 2 stores for supermarket. That's their main business. Forget about the rentals. That's not their core business. So penny stocks are not growth stocks. They're just cheap stocks which may not have enough demand to support price movement. Unless it is hyped like Uchumi. And after hyping, at some point, the people who are hyping, they will sell out, leave you with a dead stock. So real growth stocks must have, one, real demand that is supported even in their products, ability to expand or reinvest the profits, but price must go up. Strong and improving financial performance. If you look at their financials, it's not cookbooks, it's not finance accounting evaluations and such stuff in their financials, because those just project profits that are not there. Good management and strategy. Market confidence that there are more people willing to buy than the sellers, and price moves up. And you can see real demand, not hyped demand. Strong governance. Companies with transparent audited financials, compliance with the regulations. They are not always on CMA radar. So growth stocks is usually judged by investor demand, market confidence, price appreciation over years, and company ability to create value to your portfolio. Remember, we are talking about your portfolio. So before we talk about Uchumi, the community now is on all social media. be sure to check the link in the bio and join any platform. Discord, WhatsApp, Telegram, Facebook, X, TikTok, YouTube, blog, Instagram, and LinkedIn. It's all on all those. And you can always join Discord channel where now it is structured discussion and also trainings where you can learn more. The link is in the description of this video. And remember to like and share and subscribe and follow for more. So we go back to Uchumi. Uchumi, I have cautioned for investors not to buy Uchumi. At one point, I got a DM and it wasn't last Friday. I advised the client not to buy it, told me social media people are buying. He forgot the people who are telling them to buy it are the ones who are selling to you at the high prices. This is a share that has been suspended by CME. Auditor have already flagged with the latest even profits, they have told you this is not sustainable. CMA have raised the issue on the price rally even NSE. Demand blocking supply. I made noise, stop buying this stock. As of today, now supply have blocked demand. Price is going down. How far can it go down? Faster than it went up. And trust me, yeah, people will be left with a dead stock. Any share that is not giving dividend, don't be hyped by anyone. Don't be told by anyone this is a good. No. I'm in the market for the last 20 years. This is my 20th year. You can tell when I got in. When Mumias was doing well, we used to make money with Mumias. It was suspended the first time. It came back at a lower price. We bought. Fortunately, that time, in the market, we had learned how companies get suspended. When you start seeing that price run, we got out. It was hyped when it went to 0 point. People still bought. What happened? One night, CME decided to suspend it. It was not communicated during the day when people would have sold. It was communicated at night. Very early in the morning, NSE suspended it. From trading. You have no option but to stay with a share you can't sell. CME is final. Even if you go to whichever court, nothing can happen. CME is the court for stock market. Those people now, they are stuck with a share they can't sell. Let's stop playing with the truth. There are people who are hyping it on social media. They have already told you they have sold. I am seeing people still wanting to buy. Now supply have dropped demand. Price will go down. Who will buy? Remember, in the earlier case, it was demand blocking supply. So there are people who are still willing to sell as it went up, as they take profits. Now, who is willing to buy at a higher price? Supply is blocking demand. Nobody will buy. Stock will drop significantly. And trust me, there are people who in these markets will lose money. Very well. Don't play with penny stocks. Don't play with penny stocks. They look cheap, but immediately something happens, you are robbed, and the losses there. I don't want to talk. We have Transcentury. It is a penny stock. It started like a joke. They have a case with equity. That time when you see those news, market is trying to tell you as an investor, even NSE, they are trying to tell you indirectly, get out of that stock. It was announced. What happened? Overnight suspension the following day, you can't sell. Up to date, that share you can't sell. Uchumi. I repeat again, Uchumi. Just watch. And for those people who hyped, if they are listening to this video, don't try to block anyone on your social media. You told them to buy. Please don't block anyone. Answer the question they've asked. I feel pain when I see people blocked that they can't sell. It's money you're drinking. I'm in the market, I'm talking from the market, I'm not talking from social media. I work with a broker, but that broker is not in this video. You have not seen the name of that broker. Yes, I work with a broker. We have seen people cry. Don't be the one to cry. I'm seeing others hyping stocks that. Boy, KQ is a loss-making entity. It has been suspended not once. And suspension happens at night. When you wake up in the morning, you can't do anything. People move to dividend stocks. That's the only money you can, that's the only easier way you can make money in the NSE. Stress-free. Buy, hold them. I'm not paid any commissions. These trainings, I specifically say they are free. All those social media accounts I've told you to join, they are free. I do live training free, just to make sure you don't fall to some of those traps. KQ, go far away from it. It's a loss-making entity. Only that it's supported by government. Right now, they might even announce a profit because it is December. What will happen in January? The same thing we are playing with the Uchumi. It is December, they will announce a profit. Supported also by the rentals. But what will happen in January? They have employees to pay. That the profit will be eaten away by that. And after some time, they are not able even to pay those stores, they close. You want to tell me in stock market it was listed as a rental company? It is not in the real estate. It is in the, you know what they do, they are business. Read their financial results. Don't look at the profits. Go to where the auditor flags the issues. I don't know what is happening with the market. And if you are new in the market, please take time to understand the market. You will misread others and misread even yourself. A small announcement on media doesn't affect price in the market. I don't want to talk about this, but it pains me when I see people misleading others. Don't go to ChatGPT and search them you're posting to everyone, please. It's people who are putting money in. They will lose because of misunderstanding. A small court case with a company cannot affect the market. Peter going to court to do what? That can have no effect. There is no correlation. Market is only affected by anything that is major, that is affecting company financials, not other things. Huh? Let's avoid speculation. We will fall prey to wrong information. It is there out. And everybody, I think, now have become a trainer. Please be very careful. Observe what happens in the market. We will take time. Before even research is out, we will take time. What is not seen by broker and NSE, ignore it, just treat it as noise. Only major events affect company. I will do a video next time so that I clear that. Thank you so much, and I hope you make informed decisions. If there is anything that is not clear, join that Discord channel, ask, I will answer. Reach out on WhatsApp, I will answer. Let's trade with information. Thank you so much. Let's meet next time. My name is Peter Chege. WhatsApp number 0723 384 775.